I want to illustrate an example that was published by Robert Zaganis in the March 2015 issue of Money Magazine. And Zaganis writes that mutual fund and advisor fees often seem tiny and irrelevant, and just because they're about 1 to 2% or so. But the point is that relative to what you could be getting, these expenses actually end up costing investors a lot more than they realize. So I want to illustrate this example for you here today with this multi-scenario situation. So let's assume that in scenario one, you invest with a financial advisor or a mutual fund, call it mutual fund XYZ, and that mutual fund or advisor charges you 1.5% annually of your assets. So in effect, you have a 1.5% expense ratio on this mutual fund or via this advisor. We'll also assume that you earn an annualized rate of return of 6% on your assets every year. Now, let's take that same scenario and there's the same situation, but swap out the 1.5% expense ratio and trade it for a 0.17 expense ratio, which is actually the actual expense ratio of the Vanguard 500 index fund with ticker symbol VFINX. So we're just going to use this as an example. So in scenario two, you're still earning an annualized 6% rate of return. All else is equal, but the only thing that has changed is the expense ratio, which has been reduced from 1.5% to 0.17%. Now let's assume that you put $100,000 into your account in both scenarios at year zero. In 40 years, what do you think the differential will be? Again, we're assuming all else equal aside from the expenses that you pay annually on the fund or to the advisor. So as you can see here, I've calculated the results out. But I think that the answer and the value differential might shock you. So I'm going to scroll down here and show you what the results are. At the end of year 40, in scenario one, assuming you invest in scenario one, you'd have about $580,000, which is $480,000 more from your $100,000 that you started with, right? But if you invested in scenario two, the fund with the lower expense ratio, you'd actually have about $965,000. So as you can see, I'm going to take this information and I'm going to show it to you in a graph. What we see from this graph is that by paying for that expensive mutual fund or that advisor fee, even though that 1.5% seems so minimal, you lost out on nearly $400,000 of potential return over the course of 40 years. So the point here is that even what we consider to be quote unquote small fees or expenses, those fees can really make a dent in your wealth over a significant period of time, especially relative to some of the other options out there, such as index funds with lower expense ratios.